Hello everyone, welcome to this Spotlight on RegTech and Innovation webinar, organised by Ditto, the marketing, business development and communications company for the financial services sector. My name is Michael Imeson and I'm a senior content editor at Financial Times Live, the FT's conference division, and I'm also a chartered member of the Chartered Institute for Securities and Investment, the CISI, and the deputy chairman of the CISI's FinTech Professional Forum. Joining me here today for this discussion are two RegTech experts. First, we have Elizabeth Sipiere, who's head of business development at Legerity. Legerity provides software that helps companies comply with accounting rules, such as IFRS 17 for insurance companies. And the company is based in London, but has clients worldwide. And then we have Mark Demo, who's Director of Industry and Strategy at AcadiaSoft. AcadiaSoft is the leading provider of risk and collateral management services for firms trading in uncleared OTC derivatives. And the company's headquarters is in Boston, Massachusetts, and it has offices in London, New York and Tokyo, and Mark is based in New York. Now, I'll just say a few words about the topic. The use of technology to assist with regulatory compliance, RegTech, continues to grow in popularity. It requires close cooperation between all three stakeholders. That's the regulated firms, the regulator, and most crucial of all, the fintech companies providing innovative compliance software. The UK's Financial Conduct Authority is one of the world leaders in this area. And I think it's worth just mentioning that one of its projects, it's the Digital Regulatory Reporting Project. It's already run a successful pilot where part of the FCA handbook has been turned into machine-readable language, allowing computers in regulated firms to understand the rules without the assistance of humans. The computers then automatically execute the rules, they extract the relevant information from the firm's databases, compile reports, and then file them to the regulator. And major banks like Barclays and Credit Suisse took part in that pilot, as did some fintech firms. But the FCA is not the only regulator doing this. Quite a few others around the world have also embraced RegTech. The Monetary Authority of Singapore, for instance, that's been working on with banks to set up a KYC, Know Your Customer, digital identity service called MyInfo. And that allows banks to use government databases to check the identity of people wanting to open a bank account online, as long as those people have given the bank their permission. So there's a lot happening in the RegTech space, and that's we're going to hear from our speakers about their particular interest in this. So the format of this webinar is simple. First, our two speakers will present for about 10 minutes each. Then I'll ask them a few questions, and then listeners will be able to ask questions as well. In fact, you can do that during the presentations. Just type in your question. You'll be able to see the prompt on the screen, so you can start sending them in as soon as you like, and then after the presentations and my questions, we'll answer some of yours, and then we'll wrap up with some concluding remarks. So we'll start with Elizabeth. Elizabeth, please tell us what you're up to in RegTech in your firm, in Legerity.
Welcome everybody. I'm really pleased to be with you and tell you a bit about what we're doing with RegTech and Innovation for insurance. Could you move on to the next slide, Mike? So IFRS 17 is a fairly, it's not meant to be complex, but IASB and the IFRS have been trying to align the way you present your financial statements to the actual underlying business. And for insurance, this means trying to align your revenue and costs to when you actually provide an insurance service. And as you can all imagine, you know, some insurance products, you pay a premium and you might be insured for 30, 40, 50 years. So it's quite difficult to actually achieve that alignment. Added to that, insurance is all about pools of risk. So you're not talking a single contract, you're talking grouping contracts. So the IASB have brought out IFRS 17 that requires insurers to look at the profitability of a group of contracts over time and recognize the profit when in line with that it actually occurs. And actually, if you think about this, some of the bigger insurers like Aegon or DLG, these are people who have billions of pounds or dollars of coverage. I mean, they're very big entities, and they tend to have millions or tens of millions of policies. So if you've now got a sort of forecasting over the life cycle of these products grouped together, maybe over 30, 40, 50 years, you're talking about a lot of calculation and a lot of data. And as this is an emerging standard, so what happens usually, the IASB IASB sets a standard, and then everybody has to conform with it. But actually, what that conformance means can be interpreted differently by the financial advisors, the Big Four accounting firms, and by firms themselves. So there is always, with a new accounting standard, an expectation that you may need to make changes and adjustments. So these sorts of challenges are not ideally suited to legacy technology, and many insurers, when you get into the back end and the finance systems, haven't really made major innovations. They did implement Solvency II, and I think one of the big things that happened in Solvency II, they didn't really expect to spend quite as much money as they did. So IFRS 17 gives them a better chance now, having done Solvency II, if they're going to spend millions, to do it in a way that actually helps them innovate. Mike, can we move on? So at Legerity, what we've done is we've really looked at the technology out there and built a product that takes advantage of it. First of all, we're using in-memory grid technology, and that means we can process millions of transactions in minutes. And actually, finance and financial reporting is a period end process. You know, some banks have got so they're doing it, you know, much closer to real time. But in essence, this is a period end process. And so time is vastly important actually at your month end, quarter end, year end, as anybody in finance will tell you. You know, they don't want to work all weekend. So actually being able to process these huge volumes of data fast is very important. And then secondly, we've worked very hard to try and lower the total cost of ownership. The technologies now really enable you to put stuff in that over time secures you a long-term lower cost ownership. There's a lot of great open source technology out there. You know, previously we would have, you know, bought expensive database licenses, whereas we've tried wherever possible to adopt open source. We use Hazelcast, which is used by UBS, Lloyds, JP Morgan. You know, these are open source technologies that rely on the whole universe of open source editors to create something that is really stable and well run. And then of course we've opted for an AWS cloud solution, and that's been fantastic because accounting tends to be this periodic process, and of course with AWS you've got this elastic option. You buy the capacity when you actually need it. But actually on top of that, there's something you get from AWS. There's a lot of concerns about security and cybersecurity at the moment, and AWS has made a lot of investment in that. And also they've made a lot of investment in ensuring that you've got lower cost, high availability solutions. But to come back to security, that's another thing about innovation. There are technology that has been written now tends to be designed for cybersecurity. It tends to be encrypted at every stage in the process and architected for least privilege so that you don't have people with wide open permissions to be able to make changes to the software. So we've been able to benefit from all of that. And then the last innovative technology that we've been able to use is really openness. You know, in line with the concept of open source, we also have created an architecture that's very open. And yes, Mike, I was going to move on to talk about the next slide. So one of the other issues actually in finance is that your financial statements always represent the whole business. So actually, you're talking about getting data and adjusting data from across the whole of the organization, no matter how many product lines they have, no matter where they're operating in the world. And in order to do that, you really need to be working with a software company who will be open APIs, open orchestration, open libraries for rules. So we've really embraced those complex integration challenges by providing an open architecture where we actually provide a lot of IFRS 17 logic because that makes the project smoother. But at the same time, we've created an architecture where if an insurer wants to have their own rules and their own library of rules, we can integrate that into the architecture, while at the same time having this very tight regulatory requirement for double entry bookkeeping, for auditability, knowing exactly which model and which model run you're using at any moment in time. that whole dealing with a problem that has a very vast amount of data with calculations that are quite different to the way financial statements were reported before, using new technologies, creates not only a foundation for IFRS 17, but also it gives you that chance to innovate. If you're able to put in something that can handle this level of change and complexity, you can actually now start introducing a new product relatively rapidly. And one of the challenges that's happened in the insurance industry is there's been lots of front-end innovation, a lot of apps available, and some, you know, of the sort of insurtech insurers coming up will be insuring youngsters for driving a car for an hour, not for a lifetime. Some of those things are very difficult for the big players that have back ends that are much more sort of batch based and fixed in their architectures, whereas putting in this sort of open, rules based, faster technology sets up an insurer for innovation going forward. Can I have
thank you, Elizabeth. Yes, yeah. Are you finished?
Yes, finished.
Yep. Yeah, well, that was really interesting. I've obviously got some questions for you, but they'll come later because I'd now like Mark to present. Mark, over to you.
Sure, Michael. Thank you, and Elizabeth, that was interesting. Thank you for that as well. So let's talk a little bit about AcadiaSoft and RegTech. You want to move the slide, please? So we're a little different than your average fintech vendor. We operate in the post-trade derivative space, and particularly deep in OTC derivatives, right? And it's important to know just a little bit of background about how the business was conducted prior to AcadiaSoft, who changed the way derivatives are margined. But so email was the modus operandi for OTC derivative margin calls and collateral movements. And Michael, if you and I trade OTC derivatives, right, what happens is that we value the portfolio of trades between us every day. You have your value, I have mine, and it's only in the collateral process, it's only in that margin call process when I calculate exposure and you calculate it, and I determine I have exposure that needs to be covered by collateral, and I'll make a margin call to you. And then if you agree with that margin call, you'll also tell me what collateral you're going to pledge against that margin call, and then I'll need to check to make sure it's eligible for, it's part of the legal agreement, and it's eligible collateral to be pledged under the contract that we have. And so you can see if that entire process is done with people and people in email, you can see it was right for. It didn't, obviously nothing scaled, right? It wasn't particularly secure, nor was it and everything was exception based. So what AcadiaSoft did about 10 years ago was develop a margin messaging protocol, and then wrap some workflow around it to allow the firms that traded and that traded with each other to really automate the process, the margin call process from front to back, and they will take people out of the process where you had an agreed margin call and an agreed collateral movement, and focus the people on the exception that fall out of that process, if you will. And so today, nearly 60% of all OTC bilateral derivative margin calls are processed on our platform today, and as well as 100% of all initial OTC initial margin calls are delivered over our platform. So really the firms that, so this platform has been embraced globally. And let's talk, so these developments in margin messaging were taking place around the same time that the credit crisis hit in 2008, right? And And what that was is it was a massive driver for regulatory change, right? So in 2009, regulators from around the globe got together and agreed to reform their derivative markets, right? And the result was a new set of regulations that were going to be phased in over a 5-year period. So Michael, if you could move the slide, please. So just again, a quick bit of background. Before regulation, before this derivatives reform, there were two forms of margin that were exchanged to support a derivative contract, and that was variation margin, meaning the collateral that moves back and forth between myself and my trading partner, depending upon the who's in the money in the traded portfolios. And prior to regulation, parties were free to negotiate their own terms, their own specific terms that were related to threshold, meaning exposure needs to get to X amount before I'd make a margin call on you, or what's the minimum transfer amount of the margin call. We're not going to make a margin call if the amount is less than 500,000. Collateral eligibility, parties were, and the haircuts that were associated with the collateral, parties were free to negotiate those prior to legislation. And then there was generally only one form of initial margin that was posted, and that was one way, typically paid from the buy side to the sell side, the dealer counterparty, right? And it was generally on a fixed amount. It's generally a black box calculation that the dealer does and tells the buy side firm what that amount was. And it was designed to recover the placement costs to the dealer if that small buy side firm goes out of business. Well, as I mentioned, if you could turn the slide, Michael, as I mentioned, the financial crisis and Bear Stearns and Lehman going out of business were huge motivating factors for regulators to bring some, and it was in the collateral process that it was the collateral process that actually forced these banks out of business. And so there was huge intense focus on the collateral piece of the business. And so what happened was the regulators came in and standardized all the terms that were associated with the variation margin that went back and forth, and then they introduced the new regulatory it's called regulatory initial margin, where as I mentioned previously, it was previously one way from buy side to sell side. Well, now this new requirement is if you're over a certain size, it's two ways. Both parties calculate it and both parties exchange it, and it's non-netted and it's segregated at a third-party custodian. And so it's exactly what happens when regulators when government wants less of something. What do? They tax it, right? And this regulatory initial margin was a huge tax on the existing business, right? But there is like the business exists because it does provide value every day. And so let's talk about what the industry response was to that, to those regulatory initiatives, and I'll talk a little bit more about AcadiaSoft and what role we played in that. Right. So remember, we already have the margin call automation process in place, and these are the variation margin and initial margin requirements that the margin calls are based on. So Michael, if you could turn one more slide, and I'll bring us home here. So what the industry did was got together through their trade association, ISDA, the International Swaps and Derivatives Association, and they formed what was called the Working Group for Margin Reform. And what they came up with was a standard initial margin model, meaning, Michael, if you and I traded, the rules say we can use models that need to be approved by regulators to calculate initial margin. But if you use your own model and I use mine, there's no possible way that I could check what your calculation was to make sure it's correct, right? So the industry got together, created the standard model that everyone uses today. And what they did was, instead of building this functionality previously, what industry had done was build this calculation and reconciliation capability internally. So everyone spent the same amount of money to perform the process internally. given AcadiaSoft's existing position in the market, what they did, what businesses said was, oh, rather than each of us spend an enormous amount of money to comply with the rules, we'll enhance the funding of AcadiaSoft, and will enable them to become a market utility that would essentially support the calculation and the reconciliation of these inputs to identify, to make sure that we're doing the calculation correctly, help define the process of bringing firms into compliance with these new non-cleared margin rules, and then perform the reconciliation of the inputs to the standard initial margin model that both parties are doing, to identify where there are differences when a margin call is disputed. So today, fast forward, we're 3.5 years into the rollout of the non-cleared margin rules, which began in September 2016. Every firm global, and so we have 2 more phases to go: September 2019 and September 2020. So far, every firm that's in scope for the regulation uses our private cloud-based service to calculate this initial margin and then reconcile the inputs. And what happens is these firms send us over 2 million trades a day, 30 million sensitivities, and the trades and the sensitivities represent over 130 billion in exposure on a daily basis, right? So at the same time that we were building out this calculation and reconciliation functionality, we developed the concept of the AcadiaSoft Hub, right, which basically acts as the collateral operating system for the industry. And what we've done is what AcadiaSoft likes to do is focus on what we're good at, which is messaging, workflow, and calculation, reconciliation, in a secure environment that scales infinitely. And what we'd like to do is partner with financial firms or other fintech vendors who are really good at specific services that our existing clients like to use. So really the future. So what was really a local service that was 10 years ago, what was really a local service that started the automation process by using our messaging and workflow is now evolving into an industry standard shared market infrastructure that enables multiple efficiencies, and that the services that we provide could not be replicated internally within each of the firms for the cost that we can sell it back to them for, because it's a shared service platform. So they really have reaped the benefit of the standardized and shared service structure that they created over and above spending individually for each of them to comply with the rules. So that's kind of like that's the evolution of the post-trade derivative space in I think I did it in 10 minutes. Not too bad. So I'll end it there.
Thanks, Mark. Very well explained. Both topics are quite complex. The IFRS 17 that Elizabeth was talking about, and the uncleared margin rules. I thought you explained that very well. Let's go back to Elizabeth. Got a question for you, Elizabeth. It's about the fact that IFRS 17 was issued in May 2017, and it's not going to be effective until January 2022. It was going to be 2021, but there's been a 1-year delay, so 2022. That's still 2.5 years away. So why should insurers be thinking about it now when they've still got 2.5 years before it actually kicks in?
That's a good question. Actually, I was just thinking, some insurers started in 2017-18 to prepare for 21, and then it got moved to 2022. I think those that started really early, there are different reasons, but the most fundamental reason is that when you launch the standard and your financial statements from January 2022, you will have to show 2 years statements. So you will be showing your 2021 numbers as well as your 2022 numbers. And that's always the case with the new accounting standard. So therefore, everybody is now getting ready to run a project from now. Many have started now. That wasn't true earlier, but now they're all starting. And they expect to be running the project through 2020. So there's that fundamental reason. But actually, there are also the sheer scale of the project. I think there's quite a lot of organizational change, because the numbers are kind of now, the actuaries were very powerful in the insurers, but now finance has to be able to kind of audit everything right the way through. And so you've got to sort out the roles and responsibilities between actuarial and finance. And actually there are the business people and the sales channels. So there's quite a lot of organizational ownership to make the right decisions to implement this correctly, not to mention a whole project. And also, the IFRS 17 will change the way the numbers are reported. So they need to really try and get some early insight into what actually their P&Ls are going to look like, so that they're fairly well prepared for how the market receives their new numbers.
Yeah. Now, is it possible for insurers not to go down a sort of RegTech route that you've described? Could they do it with traditional methods? And if so, if it can be done traditionally, why should they do it using a method like yours rather than just doing it traditionally?
I think some of them will, and some of the ones who started very early actually have been working with the likes of SAP, and they will have a very large project and they will build something, and actually SAP has adopted a number of new technologies. I think for many, this is always the case when you're introducing a younger software company with more innovative technology. A proven vendor can appear less risky, but I think time has shown that that isn't the case. There are examples of some of the biggest players having a product out there for Solvency II, and then actually pulling it, cancelling the product because they only got 1 or 2 clients and because of the complexity. So it's not actually certain because you've chosen a traditional vendor that you have more security. But one of the things that is very important, finance systems tend to stay implemented for 20, 30 years. So when people are making a decision, they are a fairly conservative group looking at something that actually will be in place over time. Actually, that kind of argues very well for putting in a more modern technology, because obviously its longevity will be greater. But at the same time, there is a conservativeness to them who've always chosen from a small number of fairly big players.
Yeah. Okay, thanks. Mark, how's the fact that the uncleared margin rules are being phased in over 4 or 5 years, from September 2016 to September 2020? How has that long phase-in period affected the development of your platform? Has it been an advantage, a disadvantage, or what?
I'd have to call it an advantage, and it's an advantage that we've tried to turn it into financial benefits to the smaller clients that will be in scope for 2019 and 2020. Essentially, the requirement for the non-cleared margin rules means that you need to calculate this new type of initial margin, and it is quite expensive. And so what we've been doing is over time, there's no one in the world that calculates initial margin in SIMM more than AcadiaSoft. We count every phase 1, 2, and 3 firm that's in scope for the regulation as our clients. And so what we've done is really turn that into is become a one-stop shop for expand the range of services that we provided, that the banks, some of the services that the banks may have done themselves because they're larger, they have larger pools of resources. We've expanded our offerings to include the sensitivity calculation that goes into the initial margin calculation, and then the connectivity to custodians on the back end to move funds back and forth between the custodians. And so really make it simple for the smaller firm to make an easy decision to say, let's use the central utility. They would never be able to replicate the same level of the breadth and depth and scale of the service that we provide at the cost that we provide it, right? So it's really expanding to make it easy for the phase 4 and 5 firms who are still caught up in the regulation.
You said earlier in your presentation that 100% of all OTC initial margin calls are on your platform. Why do you have such a monopoly? Why are there no competitors?
Well, the largest firms were implemented first. The largest firms in the world that trade derivatives. It's a sliding scale based on size, and those firms already had implemented our margin messaging and workflow technology. So it was an easy win for them to when they worked on the project to comply with the non-cleared margin rules. They've also ensured that the calculation and the margin call and the collateral agreement process was integrated into our margin messaging and workflow product. So it was 100% automated out of the box, right? It was a brand new margin requirement. Why go backwards from a messaging standpoint? So it was an easy decision.
Yeah, and you said that 60% of the OTC bilateral variation margin is on your platform. So who does the other 40%?
Well, it's email. It's still email. So we're in the process of changing that, right? Because the firms have incredible cost pressure on them, and the level of accuracy, the speed, the scale of messaging, and letting computers talk to one another and do the work that they should be doing from a processing and agreeing standpoint. And then when there's an exception, you need the human to get involved. That's where we are. That's so we're definitely working with the rest of our client base to expand that to what we expect would ultimately be pretty close to 100%.
Okay, that's clear. Going back to Elizabeth, in developing this accounting software for IFRS 17, how closely did you work with the IFRS Foundation and the International Accounting Standards Board, which are responsible for these standards? Were they? You must have worked with them. You mentioned it earlier on. Were they quite easy to work with?
Yes. So the IASB runs their own structured process with those people who are allowed to attend their meetings, and they then release statements. And then those statements, particularly the Big Four, Deloitte, PwC, EY, they all start interpreting them, as do the various people. So it is a process, and we follow it very closely. And actually, we always say that the interesting thing about software companies, we actually have to operationalize it. You know, the advisors will talk about what it means, but we actually have to start putting this into a piece of software. But actually, the important thing about IFRS is that it is principle-based accounting, unlike old GAAP, like US GAAP, although US GAAP is about to move to something called LTDI, which is very similar to IFRS 17. But in the past, accounting tended to be rules-based. And actually, I think that was the same for a lot of financial services regulation, and a lot of financial institutions work out how to get around the rules. So the interesting thing is the IASB has been moving towards principle-based accounting, and that means that the moral responsibility sits with the insurer. And so the real work starts as the market begins to adopt the standard and the common treatment actually begins to emerge. So although all our clients have got advisors, they are really, we're starting to work through with them how they're actually interpreting the actual implementation. And I find that stage as interesting as getting the kind of actual statements out from the IASB that tell you how you are supposed to understand the standard and what it's trying to achieve. But this actual practice is very, very important as everybody starts to adopt it.
And what about the financial regulators in the UK, the FCA or the PRA? Are they involved at all?
Well, They are responsible for Solvency II, particularly the PRA, and Solvency II is a capital requirement, so effectively it's a balance sheet. So I think the greatest challenge is working out what the alignment of the numbers between the Solvency II reporting and what the IFRS 17 capital sort of position will look like, and how you can make sure that you understand why you might have differences between the two. And I think that's the main area of focus between the IASB and the work that the other regulatory bodies have been doing in insurance.
Mm-hmm. Yeah. Mark, I'd like you to explain a bit more about ISDA's SIMM, the Standard Initial Margin Model. How widely is that, well, how significant is it, and how widely is it now used?
It was a significant development, and actually we see now a bit of innovation around the edges of the firms that use it. It's very widely used today. Probably 99.9% of the trades that have been done prior or post September 1st, 2016, are margin, and for the in-scope firms are use SIMM as their standard model, and we expect that will be pretty consistent on a go-forward basis, because the other option is to use a schedule-based approach, which is defined in the regulations, but it's much more punitive from a margin perspective. So SIMM is widely used now. We expect it to continue to be from a regulatory perspective, but as the in-scope firms, as the nature of the in-scope firms change from large sell-side firms to buy-side firms, who in addition to being now required to post regulatory IM and also collect it, those buy-side firms had historically also always posted that house IA amount, that non-regulatory initial margin that was based on the discretionary, based on the credit view of the dealer. And so now, historically, the one-way house IA that was posted from the buy side to the sell side, which was based on either a VAR-based portfolio calculation that was black box, or a percentage of notional that was probably more simpler, but still dictated by the dealer. Now firms are experimenting with using SIMM because of the transparency, because of the transparency of the existing process around the regulatory initial margin, and the platform that exists today to calculate it and reconcile it. The buy side likes that concept of transparency. They don't have to. So we see firms that are experimenting with moving their other relationships where they may post house IA, the one-way IA to the dealer, moving that from VAR-based black box calculation on the dealer side to the standard initial margin model, which can be reconciled. And now the buy side has transparency and a bit more control and validation over what the dealer's calculating.
Yeah, I see. Elizabeth, you mentioned that your IFRS 17 solution is delivered over Amazon Web Services cloud platform. What are the advantages of customers using software on a cloud platform rather than installing it on their own on-premise servers, which I don't believe you allow them to do? So, and secondly, why AWS? Because there's also Google Cloud, Microsoft Azure. Perhaps you could just elaborate on that.
Yes. So we do actually. Some clients will do on-premise, and actually for our earlier implementations of other IFRS regulatory change, we were probably a couple of years ago nearer 50-50 on-premise on cloud. Now it's definitely the majority are using the cloud architecture. Compared with on-premise, it's just simpler, and you don't have your internal IT department managing all of the kit. You don't have to have your own data center. You know, it has that sort of physical piece is actually removed, and it's sitting up in the cloud. However, you do still have to have, you know, you have to have IT taking certain levels of responsibility, or the business owning, you know, who has access to it, etc., and that the security as you move stuff up and down to the cloud. So there's not nothing in IT, but that actual physical hardware is removed. The other thing is that I think most software as a service vendors, you actually get more service from the software company. So instead of just giving you a piece of software and that's kind of the relationship is then one of sort of any issues that emerge and things like that. If you've got somebody who's actually operating your software in the cloud, they're much more likely to be coordinating releasing of updates and working with you, because they're actually managing the cloud environment as well as the actual software itself, which otherwise you would have managed in-house.
Yes, yeah, that's a good point. And why AWS? They all seem much of a muchness to me, but there must have been a reason why you went for them over the others, the big ones.
It's interesting. We would have gone with, and in fact, at first we used to say we'll do whatever cloud you want, but there was a convergence of our customer base towards AWS. Recently, I've heard customers say, actually, we want to have two because we don't want to be trapped in one, so we'll probably go with two. My perception, having been with other hosting vendors before, is that the scale of the AWS investment is quite phenomenal. And one of the things about Amazon, you know, it started running, you know, the Amazon marketplace globally, and it simply has a deep understanding of what happens when you've got huge volumes of transactions and integration with many, you know, suppliers happening through the cloud. So the shape of their investment has come from a point of knowledge, and they have an amazing focus on making it simple for the users. I'm not as techy as some of our people, and yet I can understand an enormous amount of what they're actually doing with us. Yeah,
okay. Mark, what other services does AcadiaSoft provide? Do you build them in-house or buy them in? And what is your service development approach?
Well, as I mentioned, we do like to stick to. We don't pretend that we're outstanding at everything, and so what we do is like to stick to the messaging and the workflow and the hub concept in general that creates a sort of standard communication layer, or that operating system for the industry, as I mentioned, and when a service or a need comes along, and there are experts out there, industry experts, we like to partner with them to more quickly bring those services to our client base. For example, optimization is one, initial margin optimization is one example, right? There are a number of clients in the marketplace who already perform trade optimization, and what this optimization service does, that we partnered with 3 different vendors. We maintain all of the data that they need to provide the service. We partner with them to deliver it. Our clients permission their data that we maintain to be shared with the optimization provider, and what these optimization providers do is suggest hedge trades to put on to their trading book with their counterparty to stay within the compliance requirements, but to reduce their overall IM exposure. So it's a valuable. So that's one example of the type of partnering that we like to do to quickly bring shared services to the market.
Okay, thank you. We don't have much time left, but I'd like you both to sum up a key point. I've got one final question for you. Please keep your answers succinct. Elizabeth, first. You've given our listeners the benefit of your knowledge about RegTech, in particular the IFRS 17 solution. There's a lot for them to consider, but what would you like them to remember most about what you've said?
I think I'm a firm believer that technology moves forward, and so you're going to be better in the future if you go with innovation. It's going to, you know, save time and money, but actually particularly listening to Mark, the most important thing if you consider a new technology is that you've got a vendor who understands how it talks to all your existing architecture and is really open to making it work end to end. There's no point in having something just sitting there that isn't actually integrated with your whole business.
Okay, thanks. And Mark, what would you like listeners to remember most about what you've just said?
I think the answer is flexibility, scale that's delivered in a consistent or standard way, right? When you're looking for solutions, who are the people who are the innovators, and what type of market position do they maintain? As an example, as Elizabeth mentioned, the fact that we have close to 800 clients, and many of them use our standard services, but because we are event-based or event-driven and not batch processed, we have the ability to the customers have the ability to weave the solution into their DNA in the method and within the budget that they have to work with, right? Which is really key. So it gives them control over the items that they want to maintain, but yet sets them on a glide path towards using a utility in a more standard way. So clients may not use you; they'll use your product, but they may not integrate to you, or they may not use it in exactly the same way. So it's the flexibility that Elizabeth alluded to on the software as a service, right? Your ability to make changes centrally and have a change that one client requests or makes benefit every other client, right? So the speed and scale with which you can deliver innovation to your clients, they can't do it themselves internally. They can't keep up with it, and that is in my view, the true benefit of the software as a service model.
Okay, thank you, Mark. That's all we have time for. It's been a fascinating discussion. We've heard, I gave a couple of examples at the outset of how RegTech is being used. Elizabeth and Mark, you've got into a great deal of detail on very complex issues and how innovation in regulatory technology is helping your clients get round any problems, comply totally with whatever the regulators or the standard setters throw at them. Now, this has been a live broadcast. It has been recorded. It's going to be uploaded to the Ditto website. It's going to be available from tomorrow for people to watch the slides and listen to again if you wish, or to share with your colleagues. If you haven't already received notification about future spotlights, you can find out more about them by going onto Ditto's website and clicking on the Spotlight tab at the top of the page. So that's it. That's all. Thank you very much, Elizabeth Sipiere and Mark Demo, for taking part. Thank you.
Thank you.
Thank you. Bye-bye.